Welcome back to Multibagger Shares. I am Manish Goel, SEBI registered research analyst, and today we are going to decode one of the most overlooked, most underrated, and most profitable corners of the Indian stock market. We are talking about the holding company discount. Imagine walking into a shop where every 100 rupee note is being sold for 60 rupees. You would buy every single note without thinking twice. Yet this exact situation exists every single day in the Indian stock market, hiding in plain sight, inside a special kind of listed entity called a holding company. A holding company is a parent entity whose primary purpose is not to run its own operating business, but to own shares in other companies. Its balance sheet is essentially a portfolio of equity investments. Famous global examples include Berkshire Hathaway. In India, we have names like Tata Investment Corporation, Bajaj Holdings and Investment, Kalyani Investment, Maharashtra Scooters, Nalwa Sons, and Pilani Investment. The twist is that in India almost all listed holding companies trade at significant discounts to the combined market value of what they own. Discounts of 40 to 60% are common. That gap between the real underlying value and the stock price is where the opportunity lives. Let me make this real with simple arithmetic. Suppose a holding company owns a 40% stake in a subsidiary worth 10,000 crore. A 25% stake in another subsidiary worth 8,000 crore. And 500 crore of cash with zero debt. The total net asset value comes to 6,500 crore. But the holding company itself may trade at a market cap of just 2,600 crore. The gap of 3,900 crore, or 60%, is the holding company discount. For every 40 rupees you pay, you are indirectly buying 100 rupees of real assets. That is Benjamin Graham's dream come true. But the Indian market is not stupid. If these discounts exist year after year, there must be structural reasons. Let me walk you through the 6 real drivers of the holding company discount. 1. Double taxation of dividends. 2. Chronic illiquidity because mutual funds cannot easily trade these names. 3. The promoter overhang. Because families like Tata, Bajaj, Kalyani, and Godrej use these vehicles for perpetual control and will never liquidate. 4. No operating business of their own. 5. Perceived governance risk. And 6. Exclusion from major indices like Nifty and Sensex, which means no passive flow support. At Multibagger Shares, we classify Indian holding companies into 4 buckets. Category 1 is pure investment holding companies like Tata Investment Corporation. Category 2 is operating holding companies like Bajaj Holdings, which also has its own treasury. Category 3 is conglomerate parent holdings like Maharashtra Scooters. And Category 4 is cash-rich family office holdings that trade closest to NAV. Now, how do you calculate the exact discount? Follow 5 simple steps. Step 1. List every investment the holding company owns. Step 2. Multiply listed stakes by today's market price. Step 3. Conservatively value unlisted investments at book value. Step 4. Add cash. Subtract debt to get total NAV. Step 5. Divide by outstanding shares to get NAV per share. The gap between NAV per share and the current market price is your discount. A rule of thumb: if the discount is less than 30%, the stock is fully priced. Between 30 and 50% there may be opportunity. Above 50% you may be looking at a serious opportunity, but you must investigate why the discount is so wide. Discounts only matter if there is a realistic path for them to close. There are 3 catalysts that work in India. Catalyst 1 is buybacks and capital returns. Catalyst 2 is restructuring, mergers, or the mergers. Catalyst 3 is improving transparency and disclosure. Now here is where I want to deliver the most important lesson of today's video. Holding companies offer steep discounts. But steep discounts are not the same as quality compounding. Consider Titan Biotech Limited. As of today, April 11, 2026, Titan Biotech trades at 432 rupees with a market cap of 1,783 crore. Titan Biotech is not a holding company. It is a focused operating business in pharmaceutical intermediates and life sciences ingredients. 34.5% of its revenue comes from exports to 100 plus countries. It has ROCE of 16.9%, ROE of 15%, zero promoter pledging, a 14-year unbroken dividend track record, and promoter holding that rose from 48% to 55.87%. A holding company at a 50% discount might deliver a one-time 20% re-rating. Titan Biotech can compound intrinsic value at 15 to 18% annually for a decade through operational excellence. The discount play is a one-shot trade. The quality compounder is a multi-year story. This is why Warren Buffett said it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And one final reminder. A SEBI study found that 9 out of 10 individual traders in the equity futures and options segment incurred net losses. F&O is not investing. It is gambling. Close the F&O tab. Read an annual report. Study a holding company's NAV calculation. That is how you build real, durable, generational wealth. If this video added value to your investing journey, please like, share, and subscribe to Multibagger Shares. Join our free Telegram channel at Long Term Equity Y for daily value investing lessons. Remember, concentrate on quality, stay disciplined, ignore the noise, and let compounding do the heavy lifting. This is Manish Goel, signing off. Happy investing.